Good afternoon, everyone, and welcome to the Student Loan Debt Informational Webinar. If you're looking for information regarding student loans, then you're in the right place. My name is Kimberly Sanchez, and I'm an Education Policy Associate at NextGen Policy. And today's webinar is brought to you by Senator Ana Caballero, representing Senate District 14, the California Department of Financial Protection and Innovation, or DFPI, and the Campaign for California Borrowers' Rights Coalition. Si desea escuchar esta presentación en español, haga clic en el símbolo del globo llamada Interpretación en la barra de menú de Zoom y seleccione español. To get us started today, we're so excited to have Senator Ana Caballero with us today and for putting on this timely webinar when we know right now so many student loan borrowers have lots of questions. And so it's my honor to introduce Senator Ana Caballero. Senator Caballero is currently serving her second term in the California State Senate. She is a graduate of UCLA Law School and UC San Diego and has dedicated her career to advocating for working families, particularly in rural California. Senator Caballero is a woman of firsts. She was the first female mayor of Salinas in the city's 126-year history and the first Latina to represent the 28th Assembly District in 2006. In 2011, Governor Jerry Brown appointed her Secretary of the Business, Consumer Services, and Housing Agency, where she worked to improve housing, business, and consumer services across the state. In the Senate, she has authored key pieces of legislation, including the Middle Class Housing Act, SB 6, which helps families achieve home ownership, and SB 490, which ensures California students have access to locally grown quality produce. In 2023, Senator Caballero played a pivotal role in securing more than $500 million in funding to support veterans, flood victims, higher education, agriculture, and district-specific infrastructure projects. Before entering the legislature, she worked as an attorney for the California Rural Legal Assistance, representing farm workers, and later co-funded the law firm Caballero, Matcham, and McCarthy, which was recognized for its excellence. Senator Caballero is also the founder of Partners for Peace, a nonprofit dedicated to youth violence prevention and youth development programs, focusing on literacy, after-school activities, and high school dropout prevention. Born into a family of copper miners from Arizona, Senator Caballero has always been committed to empowering working families and creating opportunities for their success. Throughout her career, she has received numerous awards for her work in areas like youth violence prevention, public school construction, water sustainability, and local government support. Senator Caballero's leadership, legal expertise, and tireless dedication to serving her community make her a powerful advocate for the families of California. With that, we are so honored to have a wonderful state leader with us today. Senator Caballero, do we have you on the line?
As indicated, I'm Senator Ana Caballero, and I represent the 14th Senate District, which includes Madera, Merced, and Fresno counties. Welcome to today's webinar, where you will learn about your rights in California as a student loan borrower, the different types of student loans, and how to navigate changes to federal student loan repayment plans. I would like to thank the California Department of Financial Protection and Innovation, DFPI, and the Campaign for California Borrowers' Rights Coalition for organizing this really important webinar. In addition, I want to thank each and every one of you for taking the time to join in this critical conversation about student loan debt. Your hard work, dedication, and commitment to obtaining a good education is something to be proud of, especially for those who are first in your family to do so. It's always hard to navigate something when you're the first one in your family. And I understand that the financial challenges can be a huge barrier. That's why it's important to understand your options to ensure access to a good education. Over 4 million Californians are burdened by student loans with a collective debt of over $140 billion. This debt can affect individuals, families, and quite frankly, the economy of the state of California. Borrowers often delay major life milestones, such as buying a home or starting a family or saving for retirement, which limits their ability to build wealth and financial security, mostly because they've got these huge student loans and they need to make choices. Families, especially parents who take out loans for their children, faced increased financial stress and reduced economic mobility. High levels of student debt suppress consumer spending, slow down the housing market, and contribute to economic inequality disproportionately affecting communities of color and low-income households. That's why this webinar is so important. And that's why the information that you will learn today is so critically important, because it's important for you, your family, and the economy of the state of California. This webinar will help you to understand how to evaluate a loan, how much interest you're going to have to pay, and what the different options are for obtaining a loan, how much you can borrow, and when you have to start making payments. All of those are critically important to making a decision about whether you want to take out a loan for your education or not. I urge you to stay informed, reach out for help, ask questions, and advocate on your own behalf. Take advantage of the available programs and resources that are discussed during today's workshop. It's important to your future. The state of California has taken action to provide some really important consumer protections for you. So the webinar is step one, but also understanding what your rights are and how to protect your rights becomes really important in this process as well. Well, again, I want to thank DFPI and the Campaign for California Borrowers' Rights Coalition and all of the participants for this effort to address student loan debt and to educate the community about what their options are. Thank you so much for joining us, and I look forward to seeing your success.
Thank you again, Senator Caballero, for your support of student loan borrowers and getting important information out to Californians. So, some important information about today's webinar. Next slide, please. Please note that we do have a Spanish translator, and with that, si desea escuchar esta presentación en español, haga clic en el icono del globo titulado Interpretación en la barra de menú de Zoom y seleccione español. Next slide, please. We'd also like to note that the webinar is being recorded, and so that we can get through as much information in today's webinar, audience members' microphones and videos are muted, but the Q&A box at the bottom of your screen is available, so please drop in your questions there, and we'll be going over questions towards the end of the webinar. And as we've seen many headlines about student loans recently, please note that all information in today's webinar is accurate and up to date as of this moment. Next slide, please. As we've heard from Senator Caballero, and you'll be hearing from DFPI in just a moment, but today's webinar is also brought to you by the Campaign for California Borrowers' Rights. We're a statewide diverse coalition working to support borrowers throughout the state and no matter what stage of their student loan journey they are in. My organization, NextGen, along with the Student Borrower Protection Center, Student Debt Crisis Center, Consumer Reports, and Young Invincibles all co-lead the coalition. And you'll be hearing from Natalia from Student Debt Crisis Center today. And with that, I'll hand it off to Selena, our very own California Student Loan Ombudsperson at DFPI.
Thank you, Kimberly. Good afternoon. Thank you, everyone, for joining us today for this important webinar. Thank you, Senator Caballero, for giving us this opportunity. As mentioned, my name is Selena Damian. I am the Student Loan Servicing Ombudsperson at the DFPI. We are California's Consumer Protection Agency, and our duty is to regulate companies of financial products to ensure compliance. So this includes student loan servicers, both federal and private. Within the DFPI, we have a consumer protection division, which I fall under, where we do license student loan servicers, and then my role as the ombudsperson is there as well. So I work with student loan borrowers on a daily basis. I help them understand their options. I help them understand their repayment programs, forgiveness programs, and then I advocate on their behalf with student loan servicers and Department of Education and other agencies as needed. We do accept and evaluate consumer complaints, so that includes complaints from student loan borrowers against their student loan servicers. I think more than ever, it is really important that borrowers understand these rights and that they do file complaints, because as the enforcement agency here in California, we want to hold servicers accountable, and the only way for us to know and document everything that's going on with borrowers is to get these complaints in. So we do try to resolve the complaints. and serve as an intermediary, but we also want to know for our enforcement purposes. It's, as I said, it's more important than ever to hear from borrowers. And then another part of our duty here at the DFPI is to conduct education and outreach and to enhance consumer awareness and to protect borrowers from fraud and abuse. Next, please. Today, we will be, as Senator mentioned, we will be giving an overview of student loan types, repayment plans, and then providing debt relief updates. And then anything that we don't cover, you can also put your question in the Q&A, and we will be answering questions throughout the webinar as well. We are not financial counselors or attorneys. We are advocates and experts here to help, but we will be providing resources at the end of the webinar and throughout where you can submit more personal if you have more complex questions that we're not able to help with today, and then provide legal resources as well. And as was mentioned, the information today is accurate. As of today, things are ever changing, so it's more important than ever that you know who your student loan servicer is and that you have a studentaid.gov portal. They're going to discuss that in a few slides, and that you keep in touch and read all communications because things do change quite frequently. Next, please. As was mentioned, in California, we do have 4 million borrowers with $141 billion of student loan debt. Most of that debt is federal student loan. The average debt load of a borrower in California is $37,000, and the majority of debt is held by borrowers between the ages of 35 and 49 years old of age. The default rate in California is 7%. Between 1995 and 2017, the balance of federal student loan debt has increased more than sevenfold. In the United States, borrowers owe $1.78 trillion of student loan debt, and it is the second highest consumer debt category behind mortgages. Next, please. It is important to note that there is an outsized impact, a disproportionate impact held by women, low-income borrowers, and borrowers of color. So that could be due to a number of factors, including the rising cost of tuition and fees at public colleges and universities, the racial wage gap, which results in less family support for incoming students, predatory institutions and practices, which Department of Education has really been trying to crack down on. And then the gender and racial pay gap once a student or a borrower enters the workforce. A borrower in a 75% minority neighborhood is 5 times more likely to fall behind on their student loan payments. Women hold nearly 2/3 of the national student loan debt, and Black women have the highest rates of default. Next, please. The Department of Education recently released information about the impact of student loan debt in older Americans. So typically, or when we think of student loan debt, we think that this is a younger adult problem, or maybe a student just in their 20s and 30s, but we are seeing that the impact it's having now on borrowers over 50. So borrowers between the ages of 50 and 61 owe $283 billion in federal student loan debt, and then borrowers aged 62 and older, $117 billion. So this is a combined $400 billion of student loan debt. The majority of this debt was taken out for the borrower's own education, and the majority of this debt a borrower has held for 15 years or more. So this graph here, what it shows is that the older the borrower gets, the more at risk they are of going into default. And this is really important and to know, because at the age when a borrower or an adult is trying to retire, collecting Social Security, they are still holding this debt, which could really impact their financial livelihood and really impact their retirement years, when someone should be planning to retire, but then they still have this huge amount of debt. Next, please. So in addition to the rights that are afforded to all borrowers through the Higher Education Act and that are outlined in the promissory note that is explained during the exit counseling and in school, those are protections on the federal level. In California, we have Assembly Bill 376, the California Student Borrower Bill of Rights. Now, this law applies to servicers in for both federal and private loans, and it applies to any California borrower. So what this does is it prohibits servicers from engaging in abusive, unfair, or deceptive practices, and it requires that they work in the best financial interest of borrowers. Servicers must provide borrowers with information, accurate information, and applications for income-driven repayment plans and other forms for federal benefits and protections. And although it's not written on here, but really that includes processing your payments in a timely manner, giving you accurate information about your accounts, your interest, timely processing of your applications for both IDR plans and for public service loan forgiveness or any other forgiveness plan. Now, this is really important right now because we do know that there's a lot of misinformation that is being given to borrowers, and it's really causing a lot of confusion on top of everything else that's going on. So a lot of this guidance is coming from Department of Education. However, these servicers should be providing you the most accurate information. It does establish special protections for military borrowers, those working in public service, older borrowers, and those with disabilities. So servicers have to provide specialized training for their staff for this population of borrowers. And it protects borrowers from any negative consequences stemming from a sale, assignment, transfer, system conversion. Again, this is really important right now because we have seen many loan transfers, and we have also seen many servicers switch their platforms. So as a borrower, you want to make sure that you're keeping record of all your information. They should be keeping record of all your information and having accurate accounting, but if they don't, again, they are in violation of the law. So under the Bill of Rights, a borrower has the right to take legal action against their servicer if they fail to comply with these laws. This is known as a private right of action. Again, a very important bill, very important protection for borrowers, especially at this time. Next, please. And then I will hand it over to talk about student loan servicers and types of loans.
Thank you, Selena, for sharing that information about what student debt looks like in California and what rights everyone here today has in our state. Next, I'll be going over the different types of student loans as well as servicers, just to make sure that everyone can be sure to understand what type of loan they have. Next slide, please. So as a student loan borrower, you may be carrying either federal student loans or private student loans. Please note that it's also common to have a mix of both federal and private loans. Most of the information we'll be covering today is relevant to federal student loans, as private student loans unfortunately aren't eligible or covered by federal repayment plans and other programs. Under federal loans, there are also different types of federal loans. There are direct loans, which is where the majority of recent students will be under, Perkins loans, and FFELP loans, or Federal Family Education Loans. Perkins and FFELP loans are older programs, so there are no new borrowers under these loans as they've been discontinued, but there are certainly borrowers that still hold these loans and are still paying them off. And so if you do have a direct student loan, you may also have a direct subsidized loan, direct unsubsidized loan, direct graduate plus, direct parent plus, or direct consolidation. These loans all have different terms, such as direct subsidized loans do not start getting charged interest while you are enrolled in school or during your 6-month grace period, while direct unsubsidized loans start accumulating interest from the date of the first loan disbursement. Same for FFELP loans. You may have one of the different types of loans under this program, subsidized or unsubsidized Stafford, FFELP plus FFELP consolidation. Next slide, please. A student loan servicer is a company that services your loan, just what it sounds like. It takes your payments and it applies it to your account, processes your paperwork like any repayment plan, enrollment you may do, and etc. The federal government, as you all know, and have heard from Selena, holds many student loans, and so the Department of Education contracts with loan servicers to handle all accounts. Hopefully this visual will help you identify if you have a federal student loan or private loan, depending on your servicer. Please note that private student loan servicers may not necessarily be lenders. They can just be the servicer that is contracted by a private lender to service your loan. Besides this list, you can also tell if your loan is a federal loan or a private loan in a couple of different ways. But one of the easiest ways is if the loan shows up on your studentaid.gov account, then they are most likely a federal loan and not a private loan. Next slide, please. With that, let's go over how to make sure you have access to your federal student loans through the federal student aid at studentaid.gov. Next slide. So if you want to see if your federal student loans and see what your repayment and debt forgiveness options are available to you, you should always start at studentaid.gov. Be sure to type in the website exactly into your internet browser, because if you just search for studentaid.gov, then many times other websites pop up that could open you up to scammers, but we'll go over that and how to avoid scams later on today as well. So there have been many updates to the website, so hopefully understanding your loans on your account should be a much easier process with the updated dashboard on and we'll show you that in just a moment. So when you try to access your account at studentaid.gov, next slide, please. The login page will look like this, and if you don't have an account yet, you can see at the bottom where you can click to create one. And if you're having any issues with logging into your account or resetting your password, you can call the number that's on the screen, 1-800-433-3243, and staff from the Department of Education can help you. Next slide. So now we'll take a look at a dashboard. So here's an example of what a student aid account can look like. At the top, you'll see there's a name. Make sure that you're logged into your account and make sure that all of your personal information is up to date, your contact information, so that they can send you notices and updates. So on the right side of the screen, you can see a section towards the bottom here. In this example, with a section called My Loan Servicer. And here's where you can see any and all of your federal loan servicers. In this example, the borrower only has one federal loan servicer, which is Mohila, and the link to the servicer website is provided. You should also make sure you have the contact information for your servicers, and you can make an online account with each servicer too. Again, private student loan servicers will not show up here. So if you have been getting mail, for example, from Wells Fargo about one of your student loans, but you don't see them here, that's another indication that you likely have a private student loan. And so we want to quickly go over the details of your student aid account. So towards the middle of the screen here, you'll see the button View Details. It's a blue button in your My Aid account. When you click on View Details, you'll get a breakdown of your student loans. So next slide. So once you click on the View Details button, this is what you should see, a section that summarizes how many federal loans you have, servicers, and your total loan balance broken down by your principal and interest. If you scroll down from the summary, you'll see a section called Loan Types, and that will provide you with the details of your different federal loan types and your balances for each of these loans. So if you remember the earlier slide, this example shows that this borrower has 11 federal loans, and it looks like they have a mix of loans under the direct loan program and 3 Perkins loans. With that, I'll pass the mic back to Selena to go over different student loan repayment options.
Thank you, Kim. Next, please. So I'm just going to go over some California-specific repayment assistance programs that are available. So these are not the regular federal repayment programs. We're going to discuss that on the next slide, but I wanted to share this. This is for specific occupations, mostly medical occupations, and these grant and scholarship repayment assistance programs are available through the California Department of Healthcare Access and Information, and there's a link here. If anyone is interested, they do have yearly limits, yearly deadlines. So here you will find, in this link, you will find the specific information for each program. So again, you want to not just know your repayment options on the federal level, but you always want to look for assistance on the state level as well. Now I will hand it over.
Great, thank you, Selena. If we can go to the next slide. All right, so we're going to talk about what happens once you graduate, you get your student loan. You will be put into the 10-year standard repayment. The reason we have standard in quotes is that we know so many borrowers take 10, 20, or more years to pay back their student loans, but you will be initially placed into a 10-year standard repayment with fixed monthly payments. However, there are more options if you cannot make that fixed monthly payment. If we can move to the next slide. So we're going to go over the student loan repayment plans. As you can see, there is action required. That usually means filling out a form to apply, an application form to apply for these programs. Moving on. So there's a host of what's called income-driven repayment plans, or IDR. That's how we'll refer to all of the programs. These programs are based on your overall income as opposed to your total student loan amount, and can be incredibly beneficial for student loan borrowers. It makes your payments more affordable. The payments are calculated as a percentage of discretionary income. Don't worry, you won't have to do any math. The math is done for you, based on income and family size, not the loan amount. And I will say, if you're expecting, that counts as your family size. This helps folks with lower incomes and those who may have lost a job or have decreased incomes. It prevents delinquency and defaults. It locks in your payment for a year. So even if you start to make more money, you don't have to worry about an increase in your payment until the next year that you recertify. The con is it does extend the loan payment to 20 or 25 years. But as you can see before, it also prevents you from delinquency or default, which is something you don't want to have to do. Moving on. So this gets a little more complicated. I will say when you go to studentaid.gov, there's a student loan simulator that will tell you which plan is right for you or which plans that you qualify for. So you do not have to memorize all of these plans. There are alternative plans. These are older plans, graduated repayment, extended repayment, extended graduated repayment. It's basically what it says. Graduated is that your payments will slowly go up. Extended, they'll extend the time frame. Extended graduated, they'll extend the time frame, and your payments will slowly go up. These programs are often good for people that make too much money for the other income-driven repayment programs, yet their payment is still high. I know we live in California, cost of living is incredibly high, so sometimes you can make too much for a repayment program, but you still need help. So that's where these alternative plans come in. Then there are the income-driven that are based on your income. Save, which we're going to go over a bit more, and I've already seen a question on what's going on with that, but that's the newest repayment program. Then there's income-based repayment, pay as you earn, which is pay, and ICR, income contingent repayment. Currently, ICR is only available for Parent Plus loans. And pay is unavailable right now, but we expect to see pay and ICR come back online for all borrowers within the next few weeks. Moving forward. Okay, so here are the income-driven repayment programs, and we'll still go over SAVE in a few slides. SAVE was the most generous plan, but this is currently suspended. If you are enrolled in SAVE, you are on administrative forbearance and not accruing interest, and you do not have to make payments. But we'll go into the plans that are available. So income-based repayment, you need to have first borrowed after July 1st of 2014. So if you've taken out a loan in the last 10 years, you qualify, that they will, you'll pay 10% of that discretionary income for 20 years. There's an older IBR, which was if you took out loans before July 1st of 2014, that will be 15% of your discretionary income and 25 years. Income contingent repayment, which again is the only repayment program available for Parent Plus loans, is 20%, which we know can be very high for folks, and it's 25 years of repayment. Pay as you earn, which again is not available right now, but we expect that to come back very shortly. That you do need to show some income issues, some hardship, excuse me, and that is 10% of your income over 20 years. Next slide. So what happens if you don't make payments? You can't make payments, you haven't made a payment. There was an on-ramp period that ended on September 30th that protected you from going into default. That is now over. So borrowers who do not make payments do face the risk of delinquency and default. Delinquency is when the loan payments are not received by the due date. It will remain delinquent until you've made up the missed payments. The big thing here is that you'll be reported to credit bureaus after 90 days of non-payment. Now, we know there has not been reporting to credit bureaus quite yet, but we do expect this in the coming weeks and months. And so it's really important that you look into these income-driven repayment plans. Use the student loan simulator at studentaid.gov to see what plan is right for you so you can avoid delinquency and especially default. So default is when you don't make your payments after 270 days, which is about 9 months. The consequences of default are quite dire. So your tax refunds can be withheld. They can garnish your wages and your Social Security. No access to future federal aid. That could mean loans for your children, additional loans for yourself if you wanted to go back to college. If you are in default, there is something called loan rehabilitation, which you agree in writing to make 9 voluntary, reasonable, and affordable payments. This is a discussion that you'll have with your loan holder within 20 days of the due dates. If you make all 9 of those payments in a period of 10 months, you'll be out of rehab. The other thing you can do is, if you have not already consolidated, you can consolidate your loans into a new loan and enroll immediately in an income-driven repayment plan so you don't fall into default again. And then you can get out of default that way. Excuse me. Moving on. All right, so the SAVE plan, which I have seen some questions about. We can go to the next slide. So currently, there are lawsuits against the SAVE plan that are impacting student loan borrowers. 18 state attorneys general, led by Missouri and Kansas, have sued to block the SAVE plan. These cases are ongoing, but there is a current injunction that prevents the Department of Education from offering the SAVE plan while the litigation continues. All borrowers, if you are currently enrolled in the SAVE plan, you are on a forbearance where no interest and no interest is accruing and no payments are due. You can still apply for the SAVE plan and be placed into this forbearance until the litigation is completed. However, you will not get credit towards an income-driven repayment plan or towards public service loan forgiveness. Next slide. So we at Student Debt Crisis Center, we work with borrowers all the time. They're asking, should I apply for a different IDR plan? Well, we can't tell you on this workshop exactly whether you should or not. Here are some things to consider. So you should consider changing plans. If you're on the SAVE plan, this is specifically for people in SAVE. If you want to receive credits towards public service loan forgiveness or towards income-driven repayment programs. But you may not, unfortunately, you may not be eligible for all the different income-driven repayment plans. Things are changing by the day. So for example, Pay and ICR are coming back online. So if you don't qualify for income-based repayment, this is for folks trying to move off of the SAVE plan, you may qualify for ICR or Pay once those plans come back online. You should consider sticking with the SAVE program if you don't mind not receiving the credits for public service loan forgiveness or for income-driven repayment programs, or if you're willing to take the risk of buyback, which we're not getting into right now, but for folks working towards public service loan forgiveness, there is a buyback program where you can potentially get back some of those lost months. We do know people with higher loan amounts and large payments have been enjoying the interest-free forbearance and not having to make a payment. Moving on. So how do you apply for an income-driven repayment plan? If you want to apply or change your plan, you can do so online or via paper application. We strongly suggest going online and using the student loan simulator first, and then seeing what plan is right for you. You can find the online application at studentaid.gov/IDR/. You can find paper forms, and the link is here, and I'm sure that can be shared in the chat. You can also visit your servicer website. So if you have Mohia or Nelnet, you can go there to log in and upload an IDR application. Applicants, all applicants will need to provide income documentation. Even if you've selected in the past for what's called IRS integration, it is now required that you have to provide your income documentation. That's either your most recent tax return, W-2s, pay stubs, bank statements, interest, or dividend statements. Please note that processing times are extremely delayed and can take upwards of a month or longer. We've been hearing of 2-3 months to process the application. During this time, you should be placed in a processing forbearance. That does accrue interest, but you won't have to make a payment. If you have not been, and you're still seeing that big payment that you shouldn't be having, you should call your servicer and demand. I know this says request, but I feel that you should demand to be placed into one, as it is your right to be put into that processing forbearance. Moving on. So some things to just remember before applying for an income-driven repayment plan. Make sure to have your permanent and/or mailing address, your family size, and if you're expecting, that counts as an addition to your family. Employment information and employer address. Income documentation, you don't need all of these, just one of them, W-2, pay stub, employer letter certifying gross income, bank account statement, interest or dividend statement. And as I mentioned, even if you've opted for IRS integration in the past, you are now expected to provide income documentation. Next slide. Okay. So now let's go over pathways to debt relief and a little bit of good news on the next slide. So the current debt relief programs have been working or are working. We do know that the Biden administration has canceled $175 billion with a B dollars in debt relief for 5 million student loan borrowers. 74 billion for over 1 million public service workers. That's amazing. Prior to the administration, the numbers were drastically very low. The program wasn't working. So there's been a lot of fixes to public service loan forgiveness. 56.5 billion for more than 1 million borrowers in income-driven repayment. Almost 29 billion for borrowers who have been cheated or defrauded by their school. That's mostly for-profit schools. And 16 billion for 572,000 borrowers with total and permanent disability. Next slide. And now we're going to go over the Public Service Loan Forgiveness Program. So this program started in October 1st of 2007. That's important because while we appreciate any service you did prior to this date, that's when the program started. So your time clock can only go back as far as 2007. The way you get relief through public service loan forgiveness is 120 on-time payments or 10 years. You cannot make 2 payments in a month. It has to be monthly payments to 10 years. Payments are cumulative, not consecutive. So that means if you go in and out of your public service job, you can count that time. It doesn't have to be consecutive. And the rest of the remaining debt is tax-free. And it is tax-free at the state level as well here in California, thanks to a lot of the hard work of this coalition. So the criteria that you need to have for public service loan forgiveness: do you have a direct loan? That's all loans that have been issued after 2010. Or if you have an older loan, you would need to consolidate to get into the right loan type. Does your employer qualify? And we'll go over that. Are you in a qualifying repayment plan? We'll go over that too. And make sure to document your employment using the public service loan forgiveness form. And then make sure to apply again after you have the 120 or 10 years of qualifying payments. Moving on. So it's really the best way to maximize your benefits is to be enrolled in an income-driven repayment plan. So that means you'll pay as little as possible every month and be enrolled in the public service loan forgiveness program to receive the maximum benefit. It is feasible that you could pay $0 per month for 10 years and have all of your loans forgiven, depending on how low your income is. So moving on. So do you qualify, or do your loans qualify for public service loan forgiveness? So for the loans, you need to have all of the direct loans count: the direct subsidized, direct unsubsidized, direct graduate plus for graduate students, direct consolidation loans, including one created with a parent plus loan. But I will say for the parent plus loan, the parent needs to be working in the public service job, not their child. The employers that qualify: all levels of government, state, local, federal government counts. 501c3 nonprofits. I mean, keep in mind, many hospitals, because we hear this from nurses all the time, are nonprofits. So check to see if your institution is a 501c3. And other critical public service careers: firefighters, police officers, they all count for the public service loan forgiveness plan. The repayment plans that qualify: the standard 10-year repayment plan. I do want to make a note, not a consolidated loan, but consolidated loan standard. That can get confusing, but your 10-year standard plan and the IBR programs. So IBR, ICR, pay, save as long as it lasts, those all count as repayment plans for public service loan forgiveness. Moving on. So this is what does not qualify. So the older loans, the FFEL, or Federal Family Education Loans, and Perkins loans do not qualify. I will say you can consolidate those into a direct loan, and then you'll have a qualifying loan. Loans in default do not count until you can get them out of, rehab them and get them out of default. And this is it for federal loans only, so private loans will never count. Employers, government contractors, so you have to be a W-2 employee for those government, state, and local organizations. It doesn't work for contractors. If you work at the labor union, it does not qualify. If you are a member of a labor union, that does. And 501c4 political nonprofits do not count. In terms of repayment plans, the alternative plans, those graduated, extended graduated, do not count. And if your loan is in deferment, forbearance, or in default, again, that will not count. Moving on. Okay, so we're going to quickly go over President Biden's latest attempt to help student loan borrowers with student debt relief, which has been dubbed Plan B. And we can go to the next slide. So Plan B was proposed for borrowers who owed more than they originally borrowed, are eligible for loan forgiveness, those IDR programs, but are not enrolled in a program, have been in repayment for 20 years or more for undergraduate loans, or 25 years for graduate loans, enrolled in a low financial value program, or experiencing hardship paying back their loans. This program is not currently available. I want to be clear on that. But if it were to become available, you only need one of these criteria, not all of them. Next slide. However, just like the SAVE plan, we are seeing challenges to this as well. So we did see the initial set of rules for financial hardship, and there was two parts of Plan B. Both preliminary rules were released. Unfortunately, the final rule was held up in court. The Department of Education sent guidance to loan servicers to prepare for the actual relief of the first part of Plan B. And Mohia, the student loan servicer, leaked this to the same attorneys general that sued over student debt cancellation and the SAVE program. And a temporary restraining order has been filed and granted. The Department of Ed could still release these rules, but I believe just 2 or 3 days ago, we saw another lawsuit to the hardship part of Plan B, which is very unfortunate. We know this would have helped so many of you. And with that, I'm going to pass it back to Selena.
Thank you, Natalia. Thank you. Next slide, please.
Oh, I'm sorry, Selena. I can. I was one before you. This was just the last part of Plan B, which with the hardship rules, this could result in automatic relief for 8 million folks in total. 6 million could have received automatic. 2 million would have done an application. Many of the student loan borrowers we work with did submit comments that were due on December 2nd. Over 5,000 borrowers within a very short amount of time submitted comments letting the Department of Education know just how much they need this rule. They're being reviewed by the Department of Ed soon, and we will see if they release the final rules. It could be implemented, but we've already seen this week a legal challenge to this second part. And with that, I will now pass it to you, Selena. Thank you.
Thank you, Natalia. As you can see, there is a lot of information and it is very confusing, right? It's not a one size fits all path towards forgiveness, towards repayment. And so as a result, there's companies, some of these scammers that are taking advantage, and what they are doing is they are reaching out to borrowers. They actually purchase borrowers' information, and they know the borrower's loan balances, information, servicers, and they're reaching out via text, via email, phone calls, and they are offering, in some cases, promising student loan forgiveness. They are offering to consolidate, they are offering to lower your monthly payment. So it's really important that you know the name of your student loan servicer and that you update your contact information. So everything that we talked about at the beginning, it's really um, just important information so you protect yourself, right? You want to know who you have to be dealing with, who you should be dealing with, responding to, and your trusted sources. If you receive an email, if you receive a phone call, you can always just Google the name of the company. Many times the names will sound very official, like Student Loan Assistance Program or some sort of name like that, but Google the information and you will see that they are not a legit company. They're not affiliated with the Department of Education or with your student loan servicer. Keep in mind that now all servicers and student aid, the Department of Education, if you receive an email, look at the end of the email address. So if it's .com, it's going to be just a regular company. If it's .gov, it's going to be an official government agency. So that's really important to know. Do not give out your login information, your PIN, your student aid PIN, because in many cases what they're doing is you will sign a power of attorney and they are going into your account and they are processing these applications for you. But they are also hooking you onto these subscriptions or contracts, and it's very hard to get your money back. It's very hard to get out of these contracts. Especially we are seeing seniors being targeted because there is so much confusion and misinformation. It's really important that you protect yourself. And just remember, there's nothing that a company can do that you can't do on your own for free. As was mentioned earlier, in California, we do have, as a borrower, you do have really good resources. You have, of course, the DFPI, but then we're going to give out some more information later on of some great resources. And just remember, just if anyone is offering you special access or there's a sense of urgency, it may be a scam. The Department of Education will not send anything that sounding like that. And then file a complaint with us or with the Federal Trade Commission and the CFPB, the Consumer Financial Protection Bureau, if you have been a victim, and then to report these companies as well. Next, please. This is the contact information for the Department of Education Student Loan Ombudsman. They have an ombudsman office where they also help you resolve these issues with your servicers. And then this is the email where you can contact them directly. I am the student loan ombudsman here in California, so sometimes borrowers will file dual complaints, and with the volume of complaints, sometimes you may get better result through us. But it's, again, as I mentioned at the beginning, it's better to have these issues documented because you do want to get we do want to file enforcement actions, and then you do want to try to get your issues resolved as well. Next, please. Okay, so we are in the Q&A section, and I don't see any pending questions. Kim, do you want to?
Yeah, hi. So thank you, Selena. That was a lot of information. So now we're gonna do some Q&A. And we are inviting our Spanish audience back for this question and answer portion of this workshop. So please click on the globe icon labeled interpretation at the bottom of your Zoom menu bar and select English to rejoin the group. And please drop any questions that you have in the Q&A box. I do see one to start off from Rosanna. She's asking, why are borrowers being put into an administrative forbearance right now?
Yeah, I can start and then Selena, please jump in. So most borrowers, if you are being put into an administrative forbearance, and you didn't request it, that's because you were enrolled in the SAVE program. You may have previously been enrolled in Repay, a program we didn't talk about, which converted to SAVE. And 8 million borrowers are currently on an administrative forbearance in the SAVE program. There are other borrowers you can still call if you cannot make your payments and request a forbearance. That could be another reason, but more than not, it's probably because you are enrolled in the SAVE program.
Thanks, Natalia. A second question we have here from Anonymous. When can you change your repayment plan?
So you need to reapply each and every year, which can feel daunting for 20 or 25 years. But you also can you can apply more than that if you've seen a decrease in your income or if you've lost your job. So if your payments have gone down, you wouldn't want to reapply if your income has increased, because you'd see an increase in your payment.
Well, thank you, Natalia and Selena. I'm going to pass it off to Selena again, just to briefly go over a few resources for you all. And I just wanted to let you all know that this is being recorded and you'll get all these resources in your inbox.
Thank you. If we could move to the next slide, please. So these are some important links for borrowers. Again, these are Department of Education or FSA links. So again, where you're going to find your main, it's going to be your main portal where you can manage all your loans, information, most updated information on the SAVE plan, and why you're being affected and what steps to take. This is going to be the most updated information, information on public service loan forgiveness, and then other IDR plans and application. Next, please. And these are links to our agency and then my email as well. But I did want to highlight that we are having a DFPI is hosting a just strictly public service loan forgiveness webinar on Monday. So if you have any questions about the process, how it's being affected by the current litigation and what steps to take, I will be joined by someone from the FSA and BUD's office, so they will be on hand to answer questions. So it's going to be just a full hour of PSLF information. Again, just keep in mind that there's different paths to forgiveness, and your path or your options are going to vary, and it's going to all be depending on your loan. So whether you're just starting out, in public service, or maybe just going into repayment, it's going to look very different as someone that has had loans for 15, 20 years, right? So as I said, it's not a one size fits all, but we really want you to be as informed as possible in order to help you make the best informed decision. So your trusted resources, that have been provided today. And then next, please. In California, the DFPI has created the Student Loan Empowerment Network. This is a service that is available to all borrowers in California with both federal and private loans. Whether you have a question just about your loans and where you are with your forbearance status, or if you have even a private loan and you're in collections or possibly going through a legal proceeding, you can receive assistance here through the network. You can fill out an intake form, or you can call and speak to someone. So it's free help. Just make sure that you do have your loan information. It's very important. I know it was explained at the beginning, but I work with borrowers every day. And sometimes the first question that I always ask is, what type of loan do you have, and what's your repayment plan? Who's your servicer? The basics. And many times borrowers don't know that. So that's going to be really important for everyone to get going on their path towards really getting on track. So this is a great resource. It's free. It was created there. It's a network of organizations up and down the state. And we really want borrowers to really use this resource because not every state has something like this, and it's really needed, especially right now. Next, please. Looks like that's it for us. Kimberly.
So thank you to everyone for attending today's webinar, and special thanks to Senator Caballero and her staff for putting this on today, and to Selena at DFPI and Natalia for presenting with us from Student Debt Crisis Center. And thank you to our team members, Sam, Celine, and Andrea, who were working behind the scenes today. And thank you to everyone who joined, and please have a great rest of your day.